All right, is everybody on? Good morning. We'll go ahead and call to order the May 20th, 2025 Longview Firefighter Relief and Retirement Fund quarterly meeting. We'll start off with presentations. There's nobody in the audience for public comment that I can see. Presentation on Forbix. Jennifer and Ron, are y'all on and ready? Can y'all hear us? Guess not. Maybe having some technical difficulties. So.
Ron, can you hear us?
Ron, you might be muted, or we're muted.
Jennifer's phone number if you need it.
Well, if we need to, okay.
You can start your presentation.
Okay, great. Thank you. Good morning. My name is Ron Ross. I'm with the Forbix Group of Companies, and today I'll be going over our Forbix Income Fund. If you could please go to the next slide. Okay, great. Thank you. So a little bit, I'm going to start off with giving you information as far as the Forbix Income Fund initially, and thereafter I'll go into the background of Forbix Financial, or the group of companies that is behind the Forbix Income Fund. So right here we have pretty much a summary of the fund itself. The minimum investment is $5 million, although obviously we're taking smaller increments as we kind of build up the size of the fund. Our targeted returns are 10% for the fund. The fund is an open-ended fund. Pretty much you can either get quarterly distributions of income earned, or you can roll it over and accrue the yields for compounding. The fund is open-ended. That being the case, our lockout periods are 12 months, and thereafter you can withdraw in 25% increments quarterly. So over 24 months, you can have full divestiture of the investment. The fund assets are backed by bridge loans for U.S. commercial and non-owner occupied residential properties. We don't lend against office. We don't lend against construction. It's primarily, I would say probably 80% of the loans we make are against income property as multifamily, as well as duplexes, triplexes, or fourplexes. That's primarily what the fund is invested in. We have a 1% management fee. Our expense ratio is roughly 25 basis points. Now, obviously, that covers the third party, such as the fund administration, the servicing of the loans, and the annual audit of the fund. As far as the loans that make up the fund, they're typically between 12 to 24 months in duration. The reason we do that is we want to minimize duration risk. So typically, if the loan is made for 12 months, we might extend it for another 12 months. But we always know within 12 months, the loan will mature, therefore we get the proceeds back. And that's really important from the standpoint of if there's a black swan event or some financial crisis, you can kind of see it coming to some extent. So by having 12-month terms on the loans, it really keeps the fund liquid and minimizes exposure. The loan to value on the loans we make are typically maximum 75% loan to value, but I would say on average we're around 65%. The lien positions are first and second position liens. Majority are first position. Now, even in the second position, we would not exceed 75% cumulative loan to value. And many times what we do is loan participations, whereby we might do a loan for, let's say, 70%, and we might have 50% a regional bank like East West Bank, and then 20% us. So that way we're still in the first position. And we always, even in the second positions, if we do that, we have an inter-party agreement with the first. So this way we can't get wiped out, and we work together as far as the loan itself. Our fund administrator is CSC Global. Our fund auditor is Witham Smith Brown. And obviously this is under Reg D, Rule 506C. If we can go to the next slide, please. Great, thank you. So let me kind of give you a background on the fund, the kind of loans that we make, and kind of the background of these loans. And I'm going to kind of jump a little bit to what Forbix Financial does as far as a lender, and kind of show you how it integrates with the fund. So let me give you some background on the commercial real estate industry. In residential loans, typically there are no prepays. So when those loans are made, people can refinance a month later, 6 months later, but not in commercial real estate. In commercial real estate, because most of the funding is done by securitization, those buyers, those securities demand a yield for a certain period of time. And that being the case, it's always attached with a prepay penalty. So for example, if someone gets a 5-year loan, the prepay is 5 years. 10-year loan, 10-year prepay. So by nature of the industry is that when people get commercial loans, they want to make sure that they're maximizing the income of the property before they enter into that long-term permanent financing, because they know that they have a prepay for 5 or 10 years. Therefore, they got to maximize the income of the property. So typically in commercial real estate, for example, a borrower will, let's say, buy an apartment building. And what they'll do is they won't get permanent financing when they buy it. They will get a bridge loan or a short-term loan. And the reason is they want to get a short-term loan to buy the property and have a good 12 or 18 months to get some tenants out, fix some of the units, basically maximize the income, and then go and get permanent financing. So Forbix Financial, which is separate from the fund as a lender, what we normally do in our course of business, is when we have a borrower come to us, we give them 2 LOIs. We give them an LOI for a short-term bridge loan, and then we give them the permanent financing, which takes out that bridge loan. So historically, what we've done is on the bridge loan side, we would just broker it out to a regional bank. And then we would give the permanent financing, let's say Fannie Mae, Freddie Mac, FHA, and take out the bridge loan. So in essence, what the Forbix Income Fund is, instead of us giving that bridge loan to a regional bank, the fund itself becomes like the bridge lender. So in essence, we would go to this borrower and say, okay, from Forbix Income Fund, here's an LOI. We're going to lend you X amount. And then here is an LOI from Forbix Financial that will be your permanent loan when you get your full occupancy, fully stabilized, and that will pay off the bridge loan, which in essence pays off the loan that the fund makes to the borrower. So that's kind of the backdrop of how, as being a direct lender, we complement the fund and back and forth, vice versa. If we can go to the next slide, please. Okay. Now, this is an example of the fund. The fund's inception was October of last year. We've been averaging about a little under 1% a month. And as you can see right now, we're averaging annualized 11.11%. And then if we can go to the next slide, please. Okay, great. So I'm looking at my screen over here as well, so it's kind of hard to see on that screen over here. Now, what we were proposing was that for a select investors, we're offering a JV profit sharing venture. So when we talked about the fund itself, the fund is target returns of 10%. What we're doing is we're offering a JV co-GP profit sharing plan for seed investors. What happens is that we have soft commitments from larger pension funds that will only invest once you hit a good $100 or $200 million. So to kind of get there faster, what we're offering is for $100 million of seed capital, we're offering 20% share profit sharing in our GP. And to kind of run through the numbers is basically the total capital raise is $1 billion. So we're looking to get seed capital of $100 million, which is about 10% of the overall capital raise. We raise the other 90%. Now, in exchange for that 10% of the total capital raise of $100 million, we're offering 20% profit sharing in the partnership, in the GP or the general partner of the fund. So I'll kind of walk you through the numbers. So in essence, the return to the seed capital partner is twofold. One, when they put the seed capital in, that money actually goes into the fund as a limited partner. So, and the other part of the revenue or income that is earned by the seed capital partner is a generation of what we earn on the origination fees and the management fees. So in the first part there, you'll see that where it says JV $100 million seed capital, the 5-year return of the total income, the 20% share for the seed capital partner over 5 years is about 25%. If you divide that by 5 years, it comes to about 5% annualized. The second component is enterprise value of the fund because of what it generates in fees. So based on a 6-time multiple, it's probably a little bit higher, but on a 6-time multiple, that'll equate to about a 41% return over 5 years or 8% annualized. So on the profit sharing side, you as an investor would earn roughly 13%. In addition to that, as the LP where the capital goes to seed capital, you would get 10%. So the combined annual return would be about 23% over 5 years. If I can go to the next slide, please. Thank you. This kind of breaks down the summary of how the seed investor capital works. So the seed investor is on top, and to the left, you see where the seed capital goes into the Forbix income fund. And from that side, it earns 10% as direct as limited partner. On the right side, it gets 20% profit sharing of the general partner, which earns its fees through origination points and the management fee. If you can go to the next slide, please. Thank you. This kind of breaks down the income generation of the fund. So up top, we have the general partner. To the left is how we actually make money as a general partner. We make 1% origination fee that comes from the borrower direct to the general partner. And on the right side, we have the 1% management fee that comes from the fund. Now, one other thing that to bring up, a lot of funds that are debt funds or credit type funds like this, they a lot of times charge performance fees and exit fees. We just made it a straight 1% management fee. It's very lean. And the purpose of that is to just make it easy for investors to come in knowing that pretty much they're getting a pass through for the entire yield on their investment. So meanwhile, we make our money on the origination fee as well. So that's kind of how we make the income from the fund standpoint. And that obviously benefits a seed investor and everybody else because you can raise more capital in a quicker time frame and offer a better return to the investors. And if we can go to the next slide, please. So that kind of summarizes the fund itself. Now I want to give you background on Forbix, which is important. It kind of gives you a background on who we are, what our experience is, and how that kind of plays into the fund itself as the manager of the fund. So Forbix was established in 2011, about almost 15 years ago. We are an FHA lender, a direct lender nationwide. To give you some background, there's 3 government-sponsored agencies pretty much. You have Fannie Mae, you have Freddie Mac, and you have FHA. So out of about 4,500 lenders nationwide, only 90 are approved by the U.S. government as FHA lenders to underwrite on behalf of the U.S. government, of which they insure, and then we wrap NGNMAs and sell it on Wall Street. So we are one of those lenders. And how that kind of comes into play as far as the underwriting of the fund, it's almost a corporate culture. When you underwrite for the U.S. government and everything else, it's a lot more stringent requirements. I'll give you an example of one of them. One of them is that we walk every property. Most credit funds don't do that. They get an appraisal and they go off the appraisal. For us, from our experience of 15 years of doing this, we always walk the property, every single property. And the reason being is that, an appraisal might tell you the valuation of the property based on the comparables and so on and so forth. But unless you're on the ground, you don't really see what's around the property. You might see a freeway in proximity or certain things that might be detrimental to the sale of the property in case you do have to foreclose. And it might actually, be discount what the value of the property really is. So to give you an example of an underwrite that we may do is we might get an appraisal for a property for $1 million. And then we might say we're going to lend 70% or $700,000. And then we go and walk the property. And we notice there is either a freeway or something that maybe might impact the value of the property. So we'll go back to the borrower and say, okay, well, our valuation is $900,000. So we'll only use 70% of 900, which is $630,000 versus $700,000. So what that kind of does is give an extra buffer of protection from the standpoint of the valuation of the property. Secondly, this is more asset-based lending. In addition to that, what we do is we sometimes give personal guarantees. We will we'll do a global look at the borrower's portfolio from a standpoint of how many other properties do they have, how much money they have in the bank. And in some instances, if we want a little bit more security, we might cross-collateralize certain properties. So those are kind of the examples of what we do from the standpoint of having overlays in and above the appraisal. And if you can go to the next slide, please. Thank you. So since 2011, we have funded about $5 billion worth of loans. We've also done about $2 billion of equity participation in projects. And we currently have a portfolio of apartment units and commercial retail nationwide of about $625 million. And we have about $200 million in the same short-term credit platform that the fund has. It's about $200 million. The difference is that before we had investors in which we made a loan, and we might take, let's say the loan was $1 million. We might take investor A and investor B with $500,000 each, and then do a lien against the property and fractionalize interest, 50% for party A and 50% for party B. The difference in the fund structure is that the fund actually lends $1 million and has ownership 100%. So even though we've been managing the same platform, the same type of structure for the last 10 years, which we have 200 million under management, it's kind of hard to scale it because in that context, every time you're making a loan, you're going back to the individual investors and saying, hey, here's a property and do you want to sign on to it? Whereas in a fund structure, we just make a loan direct and the beneficiary of the note is the fund itself. So let's kind of give you backdrop as far as, even though the fund is new for about 7 months, we've been doing this for over 10, 11 years. A second one to kind of go a little bit backwards on is as far as our investment portfolio. The way that thing grew was that as a lender, we would have had over the years, we had developers come to us. And for example, let's say they were doing a project for 40 million and they had to have 8 million down payment for the project. They might have 5 or 6. So we kicked in an extra 2 or 3 million to participate with them. They handled the development side, and we pretty much were just the co-GP investors. Why that's important is that we're not just lenders, we also are investors. We understand the perspective of the borrower, we understand the inherent risk. So from the fund standpoint, as a lender, we also have our investor hat on from our experience over the last 15 years that we know every aspect of the industry and where they're coming from. So it gives you a different perspective as a lender by being an investor in these projects separately from the lending side. And the next slide, please. Thank you. This is an example of just Forbix as a lender, the scope of how we lend. For example, we did in Washington State a loan for 72 million, and we've done loans as small as 12 million or 1 million or 2 million. So our span for underwriting and making loans spans the whole gamut from, let's say, 1 million to almost 100 million. Next slide, please. So as far as let me kind of go back to the 200 million we've been managing for the last 10, 11 years. On those loans we've made, we've only had 7 defaults in an entire 10, 11 year time frame. And all those 7 defaults, there was never principal loss because obviously with all the underwriting guidelines that we put into place, with the equity that's in place and short-term duration of the loans, we're always able to recover our principal, and in most cases, even more than the targeted yield because the default interest kicked in and we pretty much worked through the properties. So that's been very fortunate for us in that time frame. And actually, let me kind of expand upon that as well. Because we're also investors as Forbix, separate from the fund, and we have the background in commercial real estate, we kind of have a preference for multifamily. And our mentality is going through 2008, for example. In 2008 financial crisis, office buildings took a big hit, commercial retail took a big hit, multifamily took a hit. The difference in multifamily is you drop the rents 10%, 15%, you're fully occupied. 12 months later, after the financial crisis, things stabilized, your rents are back up to where they were. So our mentality, our favorite asset class within commercial is multifamily, is income producing properties that people reside. Because we know people have to live somewhere and you can always adjust the rents a little bit and in essence, that minimizes potential downside risk compared to if you're in office or commercial retail. The next slide, please. So this is a comparative look back at our private credit platform, the 200 million that we've been managing for the last 10, 11 years. We kind of want to show you an example of what yields we're hitting. So we've been averaging about 11%. What we do is we took about 5 accounts that are about 40 million out of the 200 million, and we track those since 2018. And those accounts all return an average of 11% returns. And if you look at the comparative yields, we're hitting 11% returns even pre-COVID. During COVID, rates were at 0, and post-COVID. So you kind of see how the consistency of our return was 11% from 2018 till now. And then since the fund, which is the same program, just in the fund wrapper, since October, we've been averaging 11.11% for the last 7 months. So I want to just show you the consistency of our lending and this credit program we've had for the last 10, 11 years. Next slide, please. Thank you. This is an example of just 3 clients of ours that have been investing us in the private credit platform. The first one is like Monica Vespi. She's been with us since 2016. Good returns, almost 10% for the last 9 years. The Shaw Trust, and then Jeffrey L. So these are examples of about 3 people that from 2016 or 2020 till now, they've been consistently invested with us on the same private credit platform that the fund is based upon. And obviously, we have the fine print, which you guys would have the PPM and everything else. And that kind of summarizes the Forbix Income Fund and our background as a Forbix group of companies as a lender and how it kind of interplays with the Forbix Income Fund. So are there any questions? I'd love to answer them.
Anybody have any questions for Mr. Ross? Okay. Thank you for your time, sir.
Yep.
We lose you again?
Man,
Oh, sorry.
We can't hear the
Thank you.
chambers, Scott.
Gotcha. Okay. Will, if you could just let him know that we appreciate his time. So. All right, so we'll go ahead and move on to item B, presentation of first quarter pension performance with Will Harrell and Charles Smith.
Sorry, folks.
Hey, Will,
We could not hear the chambers for any questions for Ron.
Okay.
We didn't have any questions.
they can't hear us.
Yeah.
Scott needs to.
Okay.
Sorry, we're having somebody look at that right now. So.
Maria, can y'all hear me?
Yes.
Yes, sir.
Yes.
I cannot hear you. Therefore, if we have, are there any questions for Mr. Ross?
No.
That is a no across the board. I am shocked, but I'll accept it. Well, Ron, thank you very much for your time.
Thank you very
And
much.
Charles and I will visit with the board and we will circle back with you. And thank you so much for getting up so early in California.
Not at all. Thank you very much.
Thanks, Ron.
Yes, sir.
Thank you very much. Thank you.
All right, Mr. Shellhorse. I'm assuming that someone will be running, I guess, the quarterly commentary first. Good morning, everyone, by the way.
Yes, sir. Morning.
Still can't hear us.
Actually, I need the other file first, if you would be so kind. That's the one. That's the one. All right. Well, I won't be able to see that, so I'm going to, if you just give me a hot second, let me pull that up on, or wait, maybe I can. Hold on. All righty, let me pull this up. Pardon me, guys. I'll be right there. I thought I'd be able to
That is a little bit better.
read it, but that's okay. It won't take me but a hot minute.
Still can't hear us.
Somebody have his phone number? Just
Perfect.
text him, let him know we-
Okay. All right. Let's start on the market commentary. And again, I can't see y'all, so I apologize. I'm just going to run straight through this. If y'all have any questions, I guess we can hit them in between this document and the report. But appreciate your patience. We will certainly be there in person in August. All right, we'll start the Q1 market commentary. I don't have to tell y'all, it has been a pretty wild ride for the S&P 500 the first half of this year. We had tariff talks that absolutely spooked the market in the first quarter. The market fell, about 14% on April 2nd or thereabouts, or right, starting April 2nd, bottomed out on April 7th. And then on April 7th, when the tariffs were announced that there'd be a 90-day reprieve, the market went up 10% that day, which is unheard of. And so far, the market's up about 20% from that April 7th low. And for the year, pardon me, hold on one second. And for the year, the market's up about 1.62%, but I'll get into some more detail in a bit. After gaining 26% in 23 and 25% in 24, the S&P finally fell 4% in the first quarter on heavy-handed tariff proposals, which spooked both the stock and bond markets alike. As of the end of the quarter, the total return on the S&P was 8% for the trailing one-year period, 9% per year for the last 3 years, and 18.6% per year for the last 5 years. Small caps were up 11.5% in 24 and down 9.5% in Q1. They are currently down about 5.5% year to date. but the second half of the year for mid caps and small caps ought to be really great. Very positive with the favorable expected policy changes, lower taxes, lower interest rates, increased onshoring, etc. All this entire agenda that we're seeing play out from the administration will be very good for small businesses, we think, and they are about 90% of all businesses in the United States. After finishing 24 up just 1.25%, the bond index finished the first quarter of the year up 2.78%. And at the moment, it's come off a little bit because of all the money that came out of bonds and into the stock market. So you've seen yields rise again up to a little over 4.5%. And the bond index for the year is just up under 1%, about 75 basis points at the moment. The March inflation rate came in at 2.4%, down from February inflation rate of 2.8. We recently, I believe it was last Tuesday, got the April inflation number, and it was 2.3. So we're moving in the right direction. Moreover, after spiking 270% from $2.30 a dozen at the end of September to a record $8.50 a dozen at the end of February, wholesale egg prices in the U.S. have fallen 53% in the last 5 weeks, down to $3.95 a dozen, which still sounds pretty high to me. Maybe I'm getting old. Federal Reserve Board lowered the short-term interest rates from 5.25. This is from the last quarter, but I held it because we're still monitoring this. It's still very relevant. Short-term interest rates from 5.25 to 4.25 in 24, with the last cut happening, a 50% cut in October of 24. The yield on the 10-year Treasury note rose, spooking the bond market. 10-year yield, and the reason why the 10-year note, the yield rose at more towards the end of 24 was really because our fiscal house, our deficit spending, and our debt was spooking the bond markets. Now you see the interest rates going up again. That is a function of it's less a function of the fiscal problems and more a function of that money moving from bonds into stocks recently. And then real GDP grew by 3.1% in the third quarter, 2.4% in the fourth quarter of 24. And when I wrote this, they hadn't released that GDP number, but the Atlanta Fed was forecasting a negative GDP number of negative 2.2. But they recently released the GDP, and it was actually a negative 0.3%. And if you dig into that number a little bit, and if I were there and things were a little more flexible, I show you all this other document. But if you look into the GDP number and what's driving that GDP number, imports to this country are a negative in the calculation of our GDP. And when the tariff talks began late last year and certainly early this year, companies began to front run or import more ahead of those tariffs. So that large number for imports for Q1 really dinged or detracted from the otherwise positive GDP growth. Also, if you look back at the 3.1% in the third quarter, a lot of that was government spending, and that has pretty much dried up as far as GDP goes. And then U.S. unemployment rate rose slightly from 4.1%, and not dried up, but it's been curtailed. Government spending will never dry up. Unemployment rate rose slightly from 4.1% in December to 4.2% in March of 25. So that means there are about 7.1 million people who are in pretty good shape sitting on their couch as we speak. Our clients are fully invested, diversified, and rebalanced diligently. This portfolio was rebalanced in the middle of December. It will be rebalanced about 30 days from now, probably closer to 25 days from now, in order to prepare the portfolio for whatever the last half of this year brings. And there is really no telling. It looks positive. Things look like they're settling down. The bottom's been taken out, and things seem to be moving in a positive direction. I think if they get this tax bill through, you'll probably see another leg up. As they say, the market will melt up. They always say the market takes the elevator down, but it takes the stairs up. So something to consider. So the S&P was down 4% for the quarter and up 8% for the trailing year. Bond index was up 2.8% for the quarter and up 4.9% for the trailing year. Internationals have been on a tear this first half of the year. Internationals are up 17% for the year. Up 7% for the quarter, up 5.4% for the trailing year. And emerging markets are up 3% for the quarter, up 8.5% for the trailing year. And right now, emerging markets are up 9% for the year. And then oil closed the quarter at $71 a barrel. And clearly everyone has seen oil now drops. I think it's $63 a barrel today, maybe 62 bucks and change. So that's been a pretty, that's about 15% drop in the price of oil, which will be great for summer driving season, particularly as we're coming up on Memorial Day. So things are looking pretty positive. If you would please move to that other report, that would be much appreciated. Thank you so much. All right, and if you would please go to that next page. So here, let me pull this up. All right, so, pardon me. All right, so this first page is the balance sheet for the Longview Firefighters Relief and Retirement Fund as of March 31st. The total fund balance was $98,421,810.69. The current balance of the portfolio, even given all the mess that went on in April, which I've described, the current balance is $100,570,407 at the moment. So up about 1.5%, 2% from the end of March. If you would please go to the next slide. So this is a graphic representation of the prior page. Up at the top right, you'll see your large cap funds, your mid cap managers, your small cap funds, Rastegar, MFS, your international equity fund, your emerging markets, another emerging markets, those complement one another, Millennium, Magnitude, Cohesive, PIMCO, these little bitty bits from legacy bits from your prior relationship, Guggenheim, PGIM, Total Return Funds, Blackstone, which is also just a smidge now. I believe it's about $30,000. I believe I'm confusing that one. It's not 30. We'll see in a sec. Breads, Global Opportunity Fund, BlackRock High Yield, and Senior Loan ETF. And if there were an appetite for the Forbix Private Credit Fund, this would be where that fund would find itself, would be in that area up in the TCW Senior Loan ETF. As a floating rate instrument, it would be a complement to the Senior Loan ETF and would probably share that spot with Forbix, if and only if, of course, there's an appetite for their services. Next page, please. This page is the asset allocation by asset class. So you're 42% domestic equity, 10% international equity, 5% real estate, 5% emerging markets, 30% fixed income, and 6% alts with 2% cash. This next page, please. And then the next page, please. And the next page, please. So at this point, we are at 2022 on page 6. And just as a reminder, 2022, 2021, you see this inflation numbers. 2020, you're up 11.5% with very low inflation as they shut the economy down for 6 months. The actuary got a 10.14% rate of return. 11% in 21. You see inflation is now near 7%, giving us a 4% for the actuary on the real rate of return. And then 2022 was just a perfect storm, down 14%. Inflation was 6.5%. So for a number that we're trying to maintain the average of 4.5, when you drop a negative 20 into that data set, it is just devastating for that real return number. Prior to 2022, y'all were well above that 4.5% target, but that negative 20 was like a torpedo. Next page, please. So now we're on page 7, and 2023, you're up 13.8%. You can see that inflation has cooled to 3.3%, and your actuary got 10%. 2024, you're up 10.4%, 2.7% inflation, 7.5% for the actuary. The first quarter of this year, there was $1.3 million in net outflows for the quarter. Negative 66 basis points was the performance of the invested dollars, net of all investment-related fees. 1.31% inflation, so a negative 1.97 real for the first quarter of this year. So if you go all the way back 14.25 years, you have a long-term average of 4.8%, an inflation experience of 2.6%. Your assumption is 3%. And because of 22, this number has been taken from a little over 4% down to 2% by that negative nearly 21% in 2022. Next page, please. This page is your executive summary. This looks back at the 5, 3, and 1 year rankings of not only the total fund, but also the individual investment managers that lend themselves to this sort of analysis. Balanced fund, 8.9% each year for the last 5 years puts you above average. 3-year return in rank, 3.95%, above average as well. And the 1 year return in rank, 4.86%, right in the average. Looking at the individual funds, Loomis Sales Growth Fund, 22nd, 1st, and 11th. And as a reminder, we want these numbers as low as possible. And we focus primarily on the 3-year number and the 5, but particularly the 3-year number for an indication of a termination. Vanguard Equities in the 40th, Clearbridge 30th, Fidelity Low Price 18th, Hood River 6th, MFS 67th. So they're pretty much on a watch list, and you can see how that has gone to their 5-year as well. But then you look at their 1 year and it's 36. So this is one of those sort of watch list circumstances. And there's something else about that Charles and I have concluded over the years that we've really put into practice more recently, is that these value managers should really be given a little more time than the growth or core managers. And the reason for that is that they're simply out of favor for longer periods of time. And we have done case studies and tracked managers that we have terminated that were value managers, that we were very confident in our termination, and we replaced them with good managers. However, in some of those cases, we've seen the value managers really come springing back to life. And that's basically what's happened, we think, with MFS New Discovery. But in some cases, it takes a little bit longer for that to really effervesce. Fidelity Emerging Markets, 27th, Goldman Sachs, 55th, BlackRock High Yield, 23rd, and the Senior Loan ETF, 11th. Next page, please. This will be, instead of alpha in rank, it's return in rank. So Vanguard Large Cap Index Fund, 35th. And I know that I've been saying this for so long about the normalization of these core funds after 22, but you can finally basically see it. Vanguard Large Cap Index, 35th. The Mid Cap Growth ETF is not a core fund, but it's our Mid Cap Growth ETF for the fund, 19th. And then the Russell Mid Cap, 47th and 16th. And then the Small Cap Core is the only one that continues to struggle a little bit in the 70th, but we don't expect much out of a small cap core. Real estate, 22nd. That's the iShares USRT REIT that replaced Nuveen, ticker TIREX, which was originally TIAA CREF. That was replaced maybe a year ago or less. My memory is failing me at the moment. Guggenheim, I know I say this every single time, but the disposition of your 2 core plus fixed managers is just crucial for the health of the fund, because they constitute 20% of the total pension fund, and that is a lot by way of diversification. And so we've got Guggenheim at 24th, 35th, and 6th, and that's their return for the trailing 1 year. So you have a bond manager returning 6.21% over the 1 year period. And it's a diversified bond manager. And then PGIM 28th, 21st, and 22nd. So they've done 5.75%, outperforming the benchmark by a long shot. A JP Morgan Global Bond Fund, 9th, 12th, and 20th. Millennium is a hedge fund that you've had since well before I came around, well before Charles came around, 2nd, 4th, and 3rd. And your complementary hedge fund, which was hired at the last meeting, magnitude, second, fourth, and first. So they're up 10.64% for the trailing 1 year. And their year to date, magnitude's year to date is just under 3%. So as a diversifier, you can see that it's absolutely doing its job so far. I know it hadn't been long, but compared to the ag, which is up 74 basis points, 3% looks pretty attractive. Next page, please. This is your long-term return net of all investment-related fees versus your custom benchmark. I would remind you that you have 75 basis points worth of fees in the pension fund that are investment-related fees, and that includes your actuary and us and the custodian and the investment managers, and I'm forgetting somebody else, administrator, etc. All the things it takes to run the pension plan are in that 75 basis points. So your total fund, we can go back 10 years. 5.23% is a net number. A gross number is 5.26. So if you were to add that 75 basis points worth of fees back into that 523, you would have outperformed 526 by about 50 basis points. Same thing on the 7 year. 6% net versus a 5.4 gross is excellent. 5 year, 8.9 versus an 8 gross, excellent outperformance. 3.95 versus a 3.49, again, more outperformance. The 1 year, 4.86 versus a 3.45, more outperformance. And year to date, the total fund is down 66 basis points, and your custom benchmark is down 1.18%. So we've got outperformance across the board. Next page, please. Now, this page is a little more interesting, I think. I mean, yes, it's neat that there's outperformance. That's all well and good. But the real question is, why is the custom benchmark in the 80s on the 1 year? So what we were looking at before was really the effect of the manager's impact on the portfolio versus your custom benchmark. Now what we're doing is we're taking the return of the fund and the custom benchmark and ranking them both. And what you see is over this 1 year period, the custom benchmark itself is in the 80s. And what that tells me as an analyst is that that's not a manager issue. What that is that your current asset allocation is currently and has been for a few quarters out of favor. And it's easily explained. You have small cap exposure that has been out of favor as an asset class, and that has been the primary culprit. So this is not where we're looking at the managers. This is where we're looking at the total asset allocation and ensuring that it's over a long period where we want it to be, which is at least an average. So you can see that it's been out of favor for about the last few quarters, and we would expect that trend to not continue, and that there would be a reversion to the mean, and small caps and mid caps will get their due. And indeed, year to date, mid caps are outperforming the S&P 500. Mid caps are up 2.6%, and the S&P is up 1.6%. So we obviously don't think this will continue, but it is something to point out to the board. And I do find it fascinating that sometimes, despite your best efforts, despite our best efforts of keeping good managers in place, sometimes the allocation itself is simply out of favor. And that would conclude my report, ladies and gentlemen. If there are any questions, I don't know that I'll be able to hear them, but I'd be happy if you could write them on a whiteboard and hold them up, I could answer them.
Can you hear us now?
I can hear you now. Oh my gosh. Look at that. Wow. That was great. Way to go, Scott. Yes, sir. Are there any questions?
Oh, Will, this is John Newstead. The
Sure.
only question I had was last meeting I requested that we break out when y'all became managers, what time period that was, and then the performance on that.
Hold on 1 second. Let me.
Is it about 8 years?
So our first.
You were going to put it on this.
I'm so sorry, John. Yes, sir. And you wanted it on the executive summary, did you not?
No, I want it on this total plan document, this,
Oh. I see
Where it
the
breaks
unit
it down
value
by-
schedule.
yes.
Yes, sir. Understood. I apologize for that. I did not see that in my notes, and that will absolutely be there. In fact, Charles can calculate that, and we will send that after the meeting. And next time we meet, we will have that as well.
Awesome.
I apologize.
Oh, that's fine. Yeah.
Hey, John, to get a good reference, if you were to look at the return page, that 7-year mark would be pretty close.
Right. My
Oh, yeah, that's
issue
right.
is my issue is every time we have to basically make an asterisk about it at all the quarterly meetings, and there's changeover and on the well the board makeup, and so it's just easier if that's consistently explained since it's something we always reference.
Sure. I blame Charles.
I do have one question, sir. On the
Yes, sir.
Forbix, you were talking about where it would fall into and everything. How would that affect our diversification in that asset class?
Well, that's something that if there was sufficient interest in Forbix, we would model it before we could really come to a conclusion. But I suspect that it would not affect the diversification of the portfolio other than to add to it. It would be sort of a sub-sector of floating rate. So that would be, the floating rate fund you have now is more, those loans are more growth capital to middle market companies. And this obviously would be more lending to developers, say such as, multifamily developers as well. It's almost the other side of the coin of Rastegar. So, you have to understand when you begin to get into private credit and private equity, you're now doing business with not only you're a partner with the equity side, but now you're involved in the lending to those types of investments. So we don't think it would have a negative effect on the diversification of the portfolio. It would probably be a net positive, but that again is something we would model before coming to a firm conclusion.
Could we talk about getting the model so that, I like the Forbix.
We can ask for it. I'm
Yeah.
cool with it. So if you want to get a model for it, so we can at least decide
Yeah.
at that point.
Absolutely.
Okay, because we're positive toward
And-
that investment.
That way Colby.
Okay, that's what I didn't know yet. Thank you. So what we'll do is we'll put together let me think through this a little bit. We'll put together a full simulation of Forbix to different degrees. Again, just having done this as long as I have, I suspect it would be close to a 2% allocation because you've got a 4% allocation to the floating rate. And so it would probably be in that neighborhood. But what we'll do is we'll model several different scenarios, and we will attend the June meeting and simply discuss that topic, if that works for the board. And also by then, we'll have an updated unit value schedule that will have RHI's performance on it, and we'd be happy to share that with you as well.
Now, Will, this is John Newstead. I believe the
Yes,
minimum
sir.
investment was 5 million. So you would look at,
No, they said we could do a little bit less.
they could,
No,
you could do
that's
this,
a-
okay.
Their paperwork did say
Yes,
5
sir.
million, but
Okay, so
Yes,
they
sir.
didn't mention,
He said that we
yeah.
as part of
could
the
do less.
JV, they'll allow
Yes,
less,
sir.
okay. I wasn't sure if they were going
Yes,
down to
sir.
the 5 million because of the
yeah, that
JV.
was
No, sir, I believe the interest in the seed capital precludes their minimum.
All right. And then, we'll vote on it this Thursday, but I'm changing on the board. So I'll kind of express a little bit on this, but I won't be here for the decision.
Well, you're changing.
Yeah, their mayor's appointing new council member to the board. So that'll change. But to get on to this one, my biggest concern with it is that the fund is only 7-month-old.
That
And
was
that
one
is-
of Charles and I's. Yes,
That is
sir.
that's my biggest concern. This is going to where you're doing a fund. It's a completely different. It's a different model. It's a different animal altogether. And to use past performance without for their other part of the company, to me, just we don't have enough experience there.
Understood.
And then also just understand that this is highly cyclical. And so odds of recession, the more likely this will become challenged. And then they haven't really increased interest rates, even though rates have went up, which means their spread has shrank. And I don't know what the reason for that is. There's also, you got to be concerned about the geography of the markets that they're in. There was no loan allocation that was broken down. Multifamily is definitely more favorable than if they're an office or other types, but the other thing to consider is those. And there was some reference to FHA lending, which really wouldn't be applicable for the type of funding that they're doing, which is bridge loan and short-term financing. So those are all my comments and notes about it.
Yes, sir. Thank you.
You're welcome.
And we will miss you.
All right, we'll miss y'all.
We will, actually.
You've already made a great improvement to the report, and now you're going to leave?
Yes.
That's true.
Well, thank you for your service.
Thank you.
Yes, thanks for your service on the board, John.
Appreciate
Yes,
it. Thank
sir.
you, Charles.
Mr. Chairman, if there are any questions, we'll stay all day, and if there are none, then I guess our presentation would conclude.
I think we're good. Thank you, gentlemen.
Thank y'all.
Thank you, Will.
Yes, sir. We'll hang around for the remainder of the meeting if that's okay.
Sure.
Now that we
Alrighty.
can hear you.
Yeah.
All right, so moving on to items for action. Item action A, review and motion regarding recommended trades for first quarter pension performance presentation. Didn't have any, so we'll go ahead and move on with that. Item action B, review and motion regarding reconciliations for the month of April 2025 for Moody checking account, Moody disbursement, and MSSB Omnibus.
I make a motion to approve.
I'll second it.
Motion and second. Do we have any discussion? All in favor?
Aye.
Any opposed? All right. Item action C, review and motion regarding internal financial statements, April 2025.
So we're like at 98, but today we're at 100.
Yeah.
We're over
I
100
think
million.
the bottom was in the 80s, so,
Ooh, that was scary.
yeah.
A motion to approve the financials.
Second.
All right, we have a motion and a second to approve the financials. Any discussion? All right. All in favor?
Aye.
All right, review and motion regarding minutes for April 2025 meeting. Sorry, I wasn't able to be there.
A motion to approve the minutes.
Second.
Any discussion? All in favor of approving minutes for April 2025?
Aye.
Ah,
Any opposed? All right. Moving on to item action E, review and motion regarding refunded contributions to Jared Hall due to separation.
motion to approve.
Second.
Did his not get a board member signature on it?
We did that this
We
morning.
got it this
Okay.
morning.
Yeah,
Thank you.
everybody was off and gone, so we did that this morning.
Yes.
Yes, ma'am.
Okay.
All right, all in favor?
Aye.
Any opposed? Sorry. I apologize for not asking for discussion, if y'all had discussion, so. Item action F, review and motion regarding refund of contributions to Ashley Armstrong due to separation.
Make a motion to approve.
Second.
Any discussion?
And that one was already paid out, right, on the reconciliation?
Yes, sir, it looks like it.
So.
Yep. All in favor?
Aye.
Any opposed? All right, item action G, review and motion regarding rollover contributions to Brandy Parker due to separation.
A motion Motion to approve.
Second.
Any discussion? All in favor?
Aye.
Aye.
Any opposed? All right. Moving on to item action H, review and motion regarding expense reports for the Telfra peer review from May 7 through 9th in Conroe, Texas.
So Colby, Pam, and Logan went. I motion to approve.
Second.
Any discussion? All in favor of approving the expense reports for Telfra peer review?
Aye.
Aye.
Any opposed? All right, moving on to items for discussion. Discussion of upcoming retirements. None that I know of. I don't know if there's, I feel like I'm always the last to know.
Nothing that I'm aware of imminently.
Pam, anything? Everybody's here to stay for that this month.
All right, so next item for discussion is the upcoming conference, Texpers Summer Forum, August 3rd through 5th in El Paso, and the Telfra Annual Conference, October 5th through 8th in Abilene. Not sure who all is planning on attending those.
And I'm going to Texpers. I'm not far enough down my calendar to look at October yet.
I was going to try to hit both of them, so.
So
I don't know if I'll get back in, when I get back in time from a balloon race to go to the El Paso one. I gotta figure out when I'm getting back.
Yes, ma'am. All right, so next regular scheduled board meeting is June 17th. Does anybody have any issues with that time frame?
I'll be out of pocket, but I'm sure the meeting can.
It's good for me.
I will also be out of pocket, so.
Where's Colby at?
Always on a cruise.
Yeah, he's on vacation right now, so.
Good.
We may review and make sure we'll have a quorum for that and see if we can't
good
update
with
that
that
since a
date.
couple of us will be
Works
gone.
for me.
I'm good.
All right.
I want to know more about the mayor's.
Yeah.
working
I do too. I don't know if that's a
mayor's
recording
what?
conversation.
No, it just happens every year. There's new appointments.
Oh.
And so that's all it was.
Anyway, we
Do
can make a
know who that's
request.
It's going to be Councilwoman Moore. Yeah. So. yeah,
Is
that's
she
it.
gonna do her continuing education?
They have to.
Well, we greatly appreciate your time and service. for
Yes.
sure,
I
so.
enjoy being- I
I'm
enjoy
actually a
being-
little
And you
depressed
asked a
hearing
lot of
this.
questions.
so.
I enjoy
Yeah.
being part of it, but Shannon will be
Ask
a
good
great
questions,
She'll be
so.
a great addition for y'all.
Motion to adjourn.
Awesome.
Motion second to adjourn.
Aye.
All in favor?
Aye.
Thank you.